What is up, everybody? Logan here again with another video, and today I'm joined with Vance Lorn, and you guys have been loving Vance, and we've had him on for quite a bit of zero DTE videos and more, how to set up a trade. I know he has this 21 DTE strategy we've been running with the Discord as well, so there's a lot of cool things that Vance has shown us. So this video is going to be a little bit more unorthodox. We're going to go into reading moving averages across time frames, and then a couple other questions that the Discord's been throwing out at us. So we figured we'd dive into this one, but I appreciate you coming back on, man. How you doing today?
I'm doing pretty good, Logan. Thanks for having me back.
Heck yeah.
So, like Logan said, we're going to cover a couple things here today. Heavily requested in the Discord channel. Basically, we're going to go over support resistance lines, how to read the different moving averages, and how to get better fills on trades. So some of it's kind of high level, and hopefully it won't bore everybody with it. So we'll kind of jump right in. We're going to start off with support and resistance lines because this is very key to a lot of trading, especially if you're doing zero DTE stuff. Basically, if you're looking at a zero DTE trade, what you want to do is you want to kind of go into a shorter time frame to see the different areas where buyers and sellers come in. So my recommendation, first off, is to turn off candlesticks and go to the line setup like it is here. It just makes drawing your support lines a little bit easier, and it just makes it so much easier. And then when you go back to candlesticks, you'll see how it all works out. As far as a time frame setup, usually the shorter the better. I find that you get the best focus at the 15-minute interval time frame. You can go lower to 5 minutes, but you tend to get a little bit more noise in that level, whereas the 15 time frame is really good for filtering out some of that noise, but getting a really good area of where support and resistance comes in. So basically, what we're going to do, and I've set it up on the cues here, is what we're going to do is we've got this back going 3 weeks, set to the 15-minute time frame. So what you basically want to do is you want to find an area where the lines pretty much all come up to a level. So now the thing about support and resistance lines is this. It's not like a line drawn in the sand that you can't cross. It's really more of a level. So whereas some people will tell you like it has to be a hard and fast, like it has to hit a specific line, when you go back to the candlesticks, you'll kind of see how it works out. You'll get lines that approach it but don't hit it. And that's because they are really more of a level than it is a specific line. So if we go back to this level right here, which is the 397.56 level, you can see, and I'm going to actually draw a line here. So I go here to the price level, and we're going to drop it right about here. And I like to make these lines white colored, just so it looks good against the green, black, and red. And you can see that I have 1, 2, kind of a third one here, a fourth one that kind of crosses here a little bit, and then 2 more over here, and they all pretty much approach this level. And we go back a few weeks, and we go back in time, and you can see without even seeing this one right here, this one hit it. So to me, that's a really good level for the cues. So, and we'll go into more detail why that is later. So it looks like we might have another level right about here where we have a lot of support and resistance. So we're going to put a line right there as well. And we'll make that line white, make it easier to see. And again, you can see that we have 1, 2, 3, 4, 5, 6, 7, kind of a few over here, and definitively an 8 and a 9th level here. So, and we'll just draw one more just for good measure. And we're going to make this one up a little bit higher. We're going to put one right about here. Again, we'll make that white. And again, you can see that we have basically 1, 2, 3, 4 instances of it. So I'm going to turn this back over to the candlesticks now instead of the lines. And now you can see it comes into a lot more focus. So we're going to zoom into this bottom line right here. So this is where you find what I call buying and selling support levels. So when you see wicks like this, where the wick drops down, where the candle drops down and then the wick comes in, what this is basically telling you is the way you read a candlestick, and for those who don't know, is that when the candlestick starts, if it goes down from where it starts, the candlestick is red, and if it goes up from where it starts, the candlestick is green. Where you get these little lines, which are called wicks, is if it drops down or goes higher, but it doesn't close at that spot. So like on this particular candlestick right here, okay, it opened at this top level here. And during this 15-minute time frame, it went as low as this point, it went as high as this point, and it closed down here in that 15-minute frame. So what happens is when you draw these support and resistance lines, right? So like over here on this day, you can see that every single time on this day, which would have been this would have been August 30th right here. Every time the Qs dropped below the $379.50 range, buyers came in to push this up. So in regards of how this helps you get a better fill, once you have 2 or 3 occurrences of this occurring in a day, this gives you a really, really strong amount of confidence that you've reached a level where the buyers are at and it won't drop below this point. So once you have, let's say, this third occurrence, right? Now on this candle here, and again, it's a 15-minute candle, what you want to do is you want to wait for the price to come down as low as it's going to go and kind of tap this line. And then you decide, okay, let's say I want to get like in that case, that day, we would say, if the line's at the 379 mark, we want to give ourselves a little bit of room. So let's go down to like the 377 mark or 375. Let's say we do the 377.5 and do like $1.50 spread to get 16 credit. It's a good 10% return. That's how you get a better fill. Because what you're doing is you're timing your entry. You're not just saying, it's 9:30 in the morning, I'm going to do a delta 15 spread on the put side with no idea what direction the market is going to go.
Right.
Yeah, if you had done that in the morning on this particular day, probably would have made out because boom, 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 for the first hour, the Qs just took off. But when you do that type of just blind order fill, if the market goes against you, now all of a sudden you're upside down. And if with most zero DTE plays, most people will have a 2x or a 3x stop loss. If you're honoring those types of stop losses, the difference between getting 16 cents and 20 cents on a 2x play is an extra 8 cents on the trade. Because if you get in a 20 and you have a 3x stop loss, now your stop loss is a 60. If you get into 16 and you have a 3x stop loss, now your stop loss is a 48. You have an extra 12 cents of runway on that 3x stop loss. So getting a better fill means you can stay in a trade longer. Yeah, you effectively lose a little bit more, but if it gives you more room for you to be right at the same time too, and that is key, because for me, my personal mindset is if you get a better fill, you have a better chance of having a winning trade, because you can also manage that trade early. If you get in at 20 cents, right, you could get out at 5 cents left on it and sell it back for a 5-cent debit and still get 15 cents. If you get in at 16 cents and you want to get 15 cents out of it, you almost have to hold it to close. So you can potentially manage that trade a lot faster by getting a slightly better fill. And you just let the market come to you.
I was gonna say you could be out before even power hour and not even worry about any volatility at the end of the day. So
right,
that's exactly a very similar way to how I think about it too with my fills, and I think that's why I always go for either I try to get a round number on a lot of mine, like 70 or 60 or 50, because it really mentally helps you gauge. Like let's say you get 10 contracts and you got 50 credit, right? and your stop loss is when it hits $1 and it hits $1, then you only lose $500. Like, you know that, instead of like, oh, I got to fill it 23 and my stop loss then's 46, and you're just kind of all over the place with the trade. I just kind of like to look at it like that. And like you said, the differences between getting a good fill and, you see a lot of the people who trade, those Delta 5s or Delta 6s on 0 DTE, you can't really use that stop loss strategy, because if you're receiving 10 credit upon opening the position, that thing's going to go to 30 credit almost instantly if you get
Right.
$1 gets pushed back towards you,
Right.
So it's kind of crazy. It really is.
Exactly. There's a couple famous people on YouTube, and I'm not going to mention names because I don't want to dog anybody.
Mm-hmm.
But there's a couple famous people that advocate, these synthetic spread type trades, where you go 25 or 50 points wide on like a Delta 5 trade. And I'm going to be honest, the only reason why they're going wide and putting on another trade is because they don't want to throw out $80,000 in collateral to have a naked spread, on SPX.
Mm-hmm.
So they go out 25 or 50 points and they buy, they buy the long there. And so now they're only putting up $2,500 to $5,000 in collateral. The problem is if they're lucky, they're getting $100, they're getting a $1 credit on that trade, which comes out to $100. But the problem is that the short and the long are so far apart that the long provides no defense to the short. So if the trade works against you, and SPX goes down 30 or 40 points in the day, you're going to get stopped out very, very quickly.
Mm-hmm.
I personally feel that, one of the reasons why they trade like that is because they have a lot of capital. I don't have $5,000. I don't want to throw $5,000 on a trade to make $100. To me, that's not a very good risk to reward ratio, because if you have that day where today's the day the market decides to crap the bed, your max loss is $5,000 or $2,500, and you made $100, credit. I would rather personally go a little bit closer to the money, maybe get $100 on a $500 collateral, and I could buy 12 of those contracts, have the exact same maximum, loss of $5,000, but I've received $1,200 in collateral versus 100.
Yeah.
So if we both suffered a max loss, I still suffer less of a max loss on that blowout day.
Absolutely.
So, that's why, to me, I always talk about, there's two types of risk. There's capital risk and there's fear risk. Going low delta, to me, is you're reducing your capital risk. You're lowering your fear risk, but you're increasing your capital risk.
Absolutely.
Because you ultimately have more money on the table that you can potentially lose. To me, that's not a smart trade.
Yep.
That's just me.
That I think the same way. I've been more risk to reward lately. And, I think on Monday I got a 12% return, and then I got a 14% return on Wednesday's 0 DTE. Tomorrow I'm going to play it safe on Friday. Fridays have just been more unpredictable lately, I would say, where there's a lot of divergence on a lot of our indicators. So for me, I'm going to play it small, see what I can do, maybe put up 5,000 to make, $700. So I like that kind of, anytime I'm making 10 to 20%.
Exactly.
Collateral, like that risk to reward so much better, in my opinion.
It is. So here's another example. This was on September 1st. And again, remember, when I drew these lines, I drew the lines based on looking at a line graph instead of the candlestick graph. Look how perfect this setup is. You have all these, this was obviously a day to put on a call credit spread, because it's hitting the price line up here. And every time it crosses over it, the sellers come in and push it right back down. And really at this second candle right here, you probably could have made the play when it got up and pushed down. But if you waited to the second or third one and you got a much better fill when it actually crossed the line, you put in that call credit spread here, you put in a trade at this level, you go back a couple points, and yeah, because it kept bouncing around, you weren't going to get a lot of decay from a price standpoint.
Yep.
But as soon as we got into this range, like, this is the type of trade where, you're going to be in the trade longer because the only decay you're going to get is volatility decay, and you're going to get, some theta decay closer to the end of the day. People think theta occurs all day long. It really doesn't. Most theta decay occurs within the last 15, 20 minutes of the day.
Yeah.
Most of the price decay you see during the day comes in the form of price movement, or it's volatility decay. Because what happens is as this continues to happen, right, the expected move starts to fall because the computers and the calculations come in and say, okay, well, we're not crossing, we're not going past we're not passing and holding the 382 level. And so since we're not passing and holding the 382 level, the volatility on the day will drop. And then when you get this big movement right over here, this is only a 2-point movement, but it's enough to, at that point, these calls up here are going to be tremendously out of the money based on the way the day has been. And again, once you're over here, you're in the 2 o'clock level. Now this is where, again, more volatility falls out. These strikes are way out of the money. They fall into like the Delta 5 range, and they become almost worthless almost instantaneously. The only thing you're going to have left in them is a little bit of theta value until the very, very end of the day, and everything drops to zero. This is how you get a better fill. Just drawing support resistance lines. When you hit a line, you see that the testing isn't occurring, and it falls out.
Yep.
The only thing that I would add to this in this particular strategy that you always kind of want to keep an eye on, and I'm going to add it back into my chart here. I had it hidden before just to make it a little bit easier to see, is I'm a big fan of the MACD, especially on this type of trading, because this is going to tell you, the thing that MACD is a lagging indicator. So it always kind of reads it after the fact. But when you get a MACD crossover like this, and you see this type of movement, like this morning here, like pre-market, we didn't have a crossover. It's still going up. So this might be a little bit worrisome because the histogram here is going to tell you if these lines are getting farther apart or closer together. So in case you can't eyeball it. So you can kind of see here that in the morning they're going farther apart, but then they start to stagger. They start to get closer. So if you timed your entry and you see this, you're like, okay, I think we've hit a ceiling. And now you see that the MACD indicator is also agreeing with you because it's going downward. There you go. Now you have a second degree of confirmation that the price is not going to go down. It's going to, or not going to go up. It's going to go down. So this gives you just a little bit extra, mental support. And then once we get the crossover here, it tries to come back a little bit, but then because the MACD is in the bottom side, eventually we see the falling out. So,
what's it look like for today? You see some live action lagging.
Yeah.
MACD.
Swing on over here. So we're about to get a bit of a crossover here. It looks like. So you can kind of see that we had the crossover here.
Yep.
And you see how I say it's a lagging indicator. See, we had this big candle drop, and I guess it's not. It was actually fairly on because the candles were coming together, or the lines were coming together. And we had the big candle drop. We had the crossover. The thing with MACD is MACD doesn't necessarily tell you that. The MACD lines can go down, they can separate, and the price can still go back up. But what it's going to give you is a good idea of, again, if you had placed, you see this setup here, you can kind of see we're making lower highs and higher lows. So, or lower lows and lower highs. So you have an obvious, trend here. Oops. Trend line. I have an obvious trend that's going this way here. And, we have a confirmation with the MACD that, we're going to be, we're shrinking the lines. You can see that again, the lines over here are shrinking as well. And so with that type of confirmation, you've got a trend down line here. You got a trend down line in the MACD. As soon as we get to the top of this candle, or as soon as we come as close as we can to the top, if you draw that trend line, that's where you put in your trade, right? So you have a trend line. You're like, okay, this is where we're going. As soon as it touches that trend line, that's where you put in your trade. You say, okay, we're going to go down. So I'm going to put my call credit spread in, not at the line, but you say, okay, we've reached the top of where this trend is going. Let's put in our trade right here. We go up to, let's say, the 382 price line, or the 382 and a half if it's available. You put in, however wide spread you want to put in, 4 or 5 points, dollar, whatever, and you put in the trade. You collect your credit, and you let it go down. And that's how you get a better fill. This is the science behind it. If you have a belief that a certain price line is going to hold, don't just throw the trade on. Let the market come to you. Let it bounce off of where you think it's going to bounce off of based on your analysis. Get the absolute best price you can for that trade, and then let the market work for you. And that's the pro way to do it. There's far too many people, not to harp, but there's far too many people who will just throw on a trade, and they're going to get 40 or 50 credit on a trade. And, if they waited 15, 20 minutes and let the market come back toward them, they could have gotten 80 credit for the trade instead of 40 or 50 credit.
Absolutely.
And, at the end of the day, if it expires worthless, the person that still waited still made more money.
Absolutely.
So that's just that's the science behind that. I'm going to throw the lines onto the chart. Oh, they're actually already there.
Cool.
So on this chart right here, I've got a bunch of these little lines. I'm going to turn off the drawings actually to make the lines work. So basically, what I have here is I have a bunch of indicators. I have I personally like to run the 9 EMA, the 21 EMA, and then the 50, 100, and 200 SMA. Those are the simple moving averages. The EMAs filter out the exponential moving averages, filter out some of the noise. So for the lower values of the 9 and the 21, I find it makes it a little bit crisper. On the longer term ones, the 50 and the 100s and the 200s, the simple moving averages is fine because there's so many. They're using so many data points that it filters out the garbage in of itself by its own calculation. So the way the EMAs work, for those who don't know, is basically whatever your level is, whether it be a 9, 21, 50, whatever, it counts back that many candles on whatever time frame you're using. So if you're using a 1-minute chart, it looks at the last 9 minutes on the 9 EMA. The 21 EMA looks at the last 21 minutes because each candle is 1 minute. On the 15-minute chart, it looks back at the last 9 15-minute candles. And it calculates the moving averages from there. So when someone says that we have a bounce off of a certain EMA, generally speaking, for most people, they're either talking about the daily, or they're going to be talking about the hourly or the 15 or the 5. And it does depend upon what type of trading you're looking at and doing on what they're talking about. So when we talk about in the broader scope, you'll hear maybe somebody on the news or some talking head somewhere say, well, we bounced off the 50 EMA today. What they're talking about is they're talking about in the broader time frame on the daily. They're talking about these types of EMAs. So generally, when things are looking good, your EMAs will line up. In a strong uptrending market, your EMAs will line up. Oops, gosh, I can't do that. I'll pull that down. They'll line up. Some purple is my 9. The yellow dot is my 21. The white dot's the 50. The
Mhm.
red is the 100, and the green is the 200. In an uptrending market, a strong uptrending market, this is the lineup you'll see: 9, 21, 50, 100, 200. So you can see, like on Tuesday, yesterday, we tapped down, went a little bit below the 9 EMA, and bounced off it. So when somebody says, that the Qs bounced off the 9 EMA, this is
Mhm.
exactly what they're talking about yesterday and today. Today hasn't closed yet, so we can't say for certain. But with 8 minutes left, I'm gonna throw it out there and say we bounce off the 9 EMA. You can see how the candle, the wick approaches, it
Mhm.
breaks the 9 EMA line. Today it just tapped it, and then it closed above it, so it came back. This is what they mean when they say you have a bounce off the 9 EMA. So generally speaking, the big line to look for, that the big line when somebody on CNBC or somewhere else says, we want to stay above the 50 moving average, they're talking about this white line here. And I'm going to jump over to SPX, and I'm going to go back, let's say 4 months. And
Mhm.
so you can see here that we've had a couple instances where SPX has crossed and actually closed below the 50 EMA. This happened back on June 18th. We had another one here on July 19th. I fully expect us to have one next week.
Mhm.
Generally speaking, around the 18th and 19th of every month, we tend to have some serious red days. So that'll be next week, because the 19th actually is Saturday.
Mhm.
So the 18th is Friday. But if we go back, I'm going to go back 6 months. You're going to see that a lot of these down days here. This right here is the 18th, big red day here. April wasn't, so it's a little delayed, but usually around the middle of the month we have big red days.
Mhm.
So um, you can see here on this date we tapped the 50 EMA, we didn't close below it. This day we actually went down below it, then came back up and closed above it. So whenever we close below the 50 EMA, or I'm sorry, the 50 SMA, if we don't recover and come back above it, this can be the first sign of a trend change.
Mhm.
So that's what we're looking for on a daily chart. You want to close. You can close below it on a day, but then you want to recover within a day or two. We'll go back a year, and you can kind of see. So like this was last November. You can see that. See, last November we were still recovering from the COVID drop.
Mhm.
Let me go back 2 years. So um, this right here, this is the COVID-19 drop. This was the big gap down in February when, hey, COVID's hit the United States and everything just kind of, we tried to recover. You can see right here, we had the setup. We had the 9, 21, 50, 100, 200, and then within a day that we opened so low on the 24th
Mhm.
that immediately the 9 EMA crossed the 21, and we immediately started doing this downward trend where now, everything is wonky. Now, we did that for about a month. We recovered, so we still hadn't completely come back up to where everything was in the direction it should have been until closer, because we had a few pullbacks here. A lot of this is election stuff
Mhm.
over here. I don't know specifically what happened in September. Um, but coming into October, November, this was some election stuff. Uh, you know, but basically, whenever you tap the 50, if you don't recover quickly, that's where you're going to start to see the downtrend.
Mhm.
And if you get into a situation where once the 9 EMA starts to cross the other lines, that's gonna push. So a lot of technical analysis. If you had talked to me 5 years ago, maybe 10 years ago, I personally would have said the technical analysis is a bunch of hogwash. I like candlestick charts, but a lot of these calculations, the MACD, the stochastics, a lot of it to me was just self-fulfilling prophecy. People would look at something, they'd see what they wanted to see, and that's how it was. However, uh, Now I think kind of the opposite is true. Candlestick charting, for the most part, is a worthless science, in my opinion, because of computers. I have a candlestick book right here on my desk that has basically every candlestick setup known to man, and 99% of what's in that book is garbage because computers look at this stuff automatically all day long. They sniff it out. They see something, they react. The
Mm-hmm.
algorithms react instantaneously. So the same thing is true of moving averages. The computers see something, they react to it. So in a way, I believe technical analysis from these types of indicators is actually more useful today than it used to be because, Citadel will have a computer that says, well, if the 9 EMA crosses the 50 EMA, we want you to, the computer will do X. And as soon as that happens, boom. And that's why you'll see days where something this weird happens all of a sudden. And
Mm-hmm.
if you go back and look, you can almost see that it's algorithmic type trading because the computers are set to do certain actions at certain points. So moving averages and things like MACD and stochastic and RSI, I think actually have more of a place today than they did years ago because of the intervention of computers in trading.
Mm-hmm.
So now on a daily level, again, if we're looking at intraday type stuff, generally the 5 and 15 minutes is what's key. We'll go in today. Moving averages also act as support and resistance lines. So what will happen is a lot of the times we'll go over here to the 5-minute mark. You'll kind of see that what happens is that, this is SPX today, right? So in the morning, SPX was trading up a little bit. And then right about here at 10:15, it closed below the 9 moving average. And now all of a sudden you can kind of see that it keeps trading below the 9 EMA. And the 9 EMA is acting as a resistance level. Now we got a crossover here. And now you can kind of see that the tails over here, the wicks now don't want to break it. So this is where on an intraday trade, the lower the time frame,
Mm-hmm.
the stronger the resistance in a way is. So, like again with the 9 EMA, if there's people, this is where algorithmic trading comes into play, if you will.
Mm-hmm.
The 9 EMA gets crossed, and an algorithm kicks in and will short. And so you can kind of see, this is not news related yet. There was some news related activity today, but you can kind of see how we get a good crossover here with the 9 and the 21. And now the algorithms will kick in and they'll start shorting things.
Okay.
And that's where you'll get some of this intraday move. And so you can kind of see here. So once we break the 9 EMA, now this is where because now we've got a triple crossover at this point. So now you've got the 9, the 21, the 50, the 100, and the 200 are set up exactly the opposite of where you want it, where the 200's on the top and the 9's on the bottom. So now you can see how when we break the 9 EMA, the 21 EMA acts as support as well. So this is where in intraday trading, again, this is where algorithms will be set in to do things because this is where they are set up to automatically buy or sell things.
Yep.
And there are services out there that are available to retail traders where you can, get into it. Some of them are expensive, but their claim to fame is that you can bot trade. You can set up your bots to trade a certain way, and they'll do their stuff. And this is where those types of things come into play, where it looks for crossovers, and it'll that way you set it up and you walk away from it and you go play golf or whatever you want to go do.
Crazy. Awesome. Well, did we cover everything in this video? We can always cover some more in the next one too.
I believe so. I think they covered all the major questions that were out there. I'm sure if we didn't, somebody will have another one for us.
Oh yeah, they'll chime in the comments. But yeah, guys, make sure you leave a like on this video, a comment below too if you have any questions that you'd like Vance to go over in the next one. But Vance is super helpful. We've had him on quite a bit, so you're already probably pretty familiar with them. So that's going to be everything for us today. We appreciate all the support as always. And we're going to see you guys in the next one that we have Vance on. And then you guys can also join the Discord below if you'd like to come and trade with us. So That's going to be everything for me, but I appreciate you coming back on, my man.
Hey, you're welcome, sir.
Cool. All right. We will see you guys in the next one.